The collapse of Silicon Valley Bank in March 2023 was the United States' biggest bank failure since the global financial crisis in 2007 and 2008. And in this video, the last in a three-part series here on the channel looking at famous investment flops, I want to dive into some of the key things that we can learn from Silicon Valley Bank, not only when analyzing banks as potential investments, but also some lessons that would apply to more typical business models as well. At its peak, Silicon Valley Bank had a market cap of over $40 billion and it had assets on its balance sheet of over $220 billion. And SVB is going to be a somewhat unusual video in the series here. In the past couple of videos, we've looked at famous investment flops from super investors that I follow. This particular investment flop really didn't have any of the usual investors that I follow kind of caught up in the chaos, but I think it's such an extreme case and there's so much that we can learn from it that it really does warrant its own video. So if you enjoy these types of videos, be sure to subscribe to the Investing with Tom channel if you haven't already. And if you haven't seen them already, be sure to check out parts 1 and 2 in this Super Investor Flops series here on the channel. Now, I won't spend too much time in this video going through exactly what went wrong and caused the bank to fail. In this video, that's been covered pretty extensively here on YouTube. The kind of short version of the story, if you aren't familiar and have been kind of living under a rock with the Silicon Valley Bank situation in 2023, is essentially Silicon Valley Bank invested a lot of money, or essentially lent a lot of money out to the US government. They bought long-dated US government bonds. As interest rates increased in 2023, the face value of those bonds declined dramatically to a point that people with money in the bank, depositors in the bank, got scared about the bank's potential financial health, probably for pretty good reason. They ripped their money out and they caused a massive liquidity crisis and bank run at SVB, which caused its failure. And although, of course, it's bank runs that typically cause banks to fail, it's really the reason that bank runs happen in the first place. You know, the things that cause the nerves from people with their money sitting in the bank that will really be the focus of this video. We're going to look at a few different forms of risk when it comes to looking at the assets and liabilities that a bank carries on its balance sheet. These are going to be quite bank specific when we kind of first dive into some of these SVB examples, but they actually are in many cases applicable to other kind of non-bank business models as well. Now, the first type of risk we're going to focus on in this video that banks typically take is something called credit risk. Now, credit risk is very simply what is the likelihood that the bank is going to get paid back on any loan that they make. So if they write a mortgage to a given customer, the bank spends a lot of time, for pretty good reason, focusing on whether that customer has the ability to, pay their mortgage on time. They do some stress testing on that customer to say if interest rates go up or if their income goes down a little bit, can they still make their payments? What is the chances that we are likely to get our money back if we give this person a loan? That is what credit risk is all about. Now, in the case of the Silicon Valley Bank collapse, most of the issues were in a sort of long-term bond portfolio. A lot of those bonds were actually US government bonds, and people often refer to the rate being paid on certain types of US government bonds as the risk-free rate. And that's actually because they have a remarkably good credit risk profile. If the government ever gets into a situation where they can't pay their debts, they happen to have a thing called a money printer and they can make more money and kind of still pay you back. So that is really the gold standard in terms of credit risk, and you get kind of increasingly risky from there. Way out on the risk curve would be funding, very speculative businesses and so on. But from a credit risk perspective, Silicon Valley Bank, at least in their big bond portfolio, was in a pretty healthy place. And in a slightly different form, many other businesses take something kind of equivalent to credit risk as well. Essentially, regular companies spend money all the time on acquiring new assets, and they hope to be paid back by making those investments. Every time Chipotle Mexican Grill goes out and opens a new restaurant, for example, that requires an initial outlay of capital. They're taking some risk in opening up this new store. They obviously have a pretty proven business model, but they want to make sure they get paid back on those projects. Same goes for if Costco open a new store, or if Microsoft spend time developing some new sort of cloud microservice offering. They want to make sure that if they spend the money to make this investment and have an asset that will sit on their balance sheet, that they have a very good chance of getting paid back on that investment. Now, the second type of risk a bank typically takes when they write a loan or they buy a bond, they have something that'll sit there as an asset on their balance sheet and earn presumably a rate of interest, is interest rate risk. Interest rate risk is a little different to credit risk. Credit risk being basically the likelihood that the bank gets paid back. Interest rate risk, on the other hand, is the likelihood that the value of the asset on the balance sheet will be impaired by changes in interest rates. And for Silicon Valley Bank, this is where they really got into trouble. They bought long-dated, very low coupon bonds, low sort of interest rate bonds. And as interest rates rose, and you were able to purchase new bonds with higher interest rates, the old bonds with the lower interest rates weren't worth as much money. And as we'll get to later in this video, that's not necessarily a problem for someone like Silicon Valley Bank as long as they can hold on to these bonds to maturity. But you do need to be able to play out your hand, or else you're going to take a big capital loss should you have to sell those bonds early, which is really exactly what happened to SVB. Now, interest rate risk isn't something that's that commonly discussed outside of the banking business, but it is applicable to other types of businesses as well. In a lower interest rate world, more marginal businesses, lower return on capital businesses will be more likely to get funded versus if they exist in a high interest rate world. If you have a business idea that, if executed well, will earn, say, 15% return on capital, that's a business you can likely find funding for and pretty much all economic environments. But if your great business idea, well executed, might only earn, say, a 7% return on capital, if you do a really good job, that is a more marginal business that's going to be tougher to fund in a higher interest rate environment. We see the management of interest rate risk show up in other areas in the investment world as well. Classic is Warren Buffett's cash pile. He famously, for a few years now, has had a very large stack of cash at Berkshire Hathaway. That's not literally sitting in a bank account in cash. For the most part, it's actually in short-term government bonds, and there's a very good reason why Buffett chooses to put it in short-term government bonds. Now, typically you can get a greater yield by buying a longer-term bond. It's kind of finance 101 that if you lock your money up for a longer period of time, you tend to get a higher rate of interest. But Warren Buffett needs to have that cash available pretty much at any point in time. Those short-term treasuries are really sort of a holding pen for, purchasing power for money that Buffett wants to be able to take at any time and plow into a business acquisition or a stock purchase, at a moment's notice when he finds something interesting. Now, the final type of risk, or sort of the thing that went wrong at Silicon Valley Bank, is really to do with kind of leverage, but also the type of funding that Silicon Valley Bank had. Now, banks in most cases are funded primarily through deposits. People will leave their money in the bank. Silicon Valley Bank in this case will pay a rate of interest on that cash that's sitting there. They will then take that money and lend it out at hopefully a higher rate of interest and capture kind of the spread between what they're paying depositors and what they're earning on loans. And there's this notion in the banking industry that there are well-capitalized banks and poorly capitalized banks. A well-capitalized bank being a bank that has a lot of equity relative to the loans and deposits that they have, and a sort of poorly capitalized bank being one that has a pretty slim amount of equity relative to the loans and deposits that they're kind of working with. To me, the notion of a well-capitalized bank is a bit of an oxymoron. We might be talking about a bank that maybe has assets that are 8 or even 10 times its equity still, which in any other industry would be an incredibly leveraged operation. A bank that's leveraged 10 to 1 would be kind of the equivalent of you having $100,000 in equity on $1 million house, which means you have, a lot of liabilities built into that equation. Now, an entity like Silicon Valley Bank operating in that way is not necessarily out of the ordinary. It's really just the nature of the business model. Banking is kind of one of the weirder business models that sort of exist in the world, but it's been around for a long time, and it works basically like this. You take money in deposits, like I said earlier. Let's say you pay 1% interest on average on all your deposits. You then lend some money out, like I mentioned earlier. Let's say you capture on average 4% interest on your loans, giving you a spread of 3%. 4% on the loans, minus 1% on the deposits. That will then leave you with something called your net interest income. You'll see that on the income statement for every bank that you look at the financial statements for. You'll then have a whole range of operating costs. So you'll have to pay to, rent out the branch that the bank operates in. You'll have to pay, salaries to your employees and so on. And that will leave you obviously a smaller amount of money at the end of the day and sort of your equivalent of operating income in most businesses. And that might only give you a return on assets of, say, 1.5%. It's then the leverage that's built into the business model that kind of inflates that return on assets up, say, 10 to 1, and gives you a much more satisfactory, say, 15% return on equity in this example. Now, of course, there's nothing inherently evil about running a business with a lot of leverage, and it's really just the nature of the banking business model that you have a balance sheet that's set up this way. There's not really that much you can do about it, but it does add risk when your assets get impaired, like when you take a lot of interest rate risk in the case of Silicon Valley Bank by writing these relatively low rates, long duration bonds. And the point to all of this is really that Silicon Valley Bank just didn't get to play out their hand. Now, they did make a very poor investment by putting a bunch of their assets into these long-term low-rate bonds, but if they were able to hold them right until the bonds matured, they would have got their money back. Sure, they would have earned a very low return, but it wouldn't have been much of an issue. The issue came when people started to pull their money out of the bank. They were forced to sell these long-term bonds at a loss, and it became increasingly apparent that Silicon Valley Bank didn't have a whole lot of tangible equity left. Now, there are other types of businesses that carry quite a lot of leverage as well and can actually work quite well because the leverage is much more sticky. Again, if we go back to Warren Buffett's Berkshire Hathaway, they have very large insurance operations that carry a lot of what's called float. Now, float is simply the customer's money, essentially, that sits at Berkshire Hathaway's insurance operations in the period of time between a customer paying their insurance premium and potentially claiming on a policy if they need to. Berkshire Hathaway have got a lot of benefit over the years of being able to take that float while it sits with them in the meantime, and they've been able to invest that money in stocks and in buying businesses, and they've earned a return on that float, as they basically hang on to other people's money. Now, float is similar in a lot of ways to deposits at a bank in terms of them being other people's money and they can earn a return on it, but it's importantly different in the fact that people can pull deposits out of a bank at any moment, and they really can't pull float out of Berkshire's insurance operations. So again, nothing inherently wrong or evil about a business that carries a lot of leverage, but it does add risk to the equation, and if you make big bets, again, nothing necessarily wrong with that, but when you make these big bets in business, you really have to be able to play out your hand and you have to get to the finish line. The last thing you want that can cause complete chaos, like we saw here with Silicon Valley Bank, is not having the ability to play out your hand, to play out the full duration of those bonds, because you've had your funding source with customer deposits kind of yanked out from underneath you. So what can investors learn from all of this, whether you're interested in making a bank investment or whether you're interested in making investments in other more typical kinds of companies? Well, I guess firstly on banks specifically, the real number one thing that can absolutely kill a bank is just writing bad loans. And typically when people think about whether they've written a good loan or a bad loan, they're often thinking about credit risk, the likelihood that they will get their money paid back to them over time. But increasingly we're seeing with increases in interest rates that people are having to focus much more on interest rate risk. That is, whether the value of those loans will be impaired by changes in interest rates. And finally, a lesson that keeps getting enforced over and over and over and over again in a lot of big investment mistakes is that leverage can kill. Leverage is a double-edged sword that works really well and can juice your return on equity in a positive direction when it's working for you, but can really kill your returns on equity and cause you to lose substantially more money than you would have otherwise when things business-wise aren't working so well. So I hope you enjoyed this video going through some different types of risks, specifically through a banking lens in this video, but a lot of the lessons are applicable to other types of businesses as well. And I really hope that you enjoyed this short 3-part series here on the channel too. If you did and you want to follow along for more videos here on the channel, be sure to subscribe if you haven't already. But that's it from me for this one, and I'll see you on the next video. Cheers.